So I'm going to start with some basic explanations because a lot of people, believe it or not, there's a lot of differentiation between what is and isn't a mine. The most famous one is the Mark Twain quote, in terms of it's a hole in the ground owned by a liar. That comes from the fact that mining promoters have had a very long and varied history of overselling what's in the ground. And they started doing it 250 years ago, and I'm afraid they haven't stopped. So realistically speaking, my best advice for you is don't listen to a mining promoter. The only way to truly invest in the mining space is by doing your homework. And you have to understand one fundamental thing. Mining is a business. Ultimately, you have to extract minerals from the ground, make and successfully and realistically and safely make a profit. Never forget that when they're talking to you about huge numbers of ounces and thousands of pounds and 50 acres and gold strikes and all of that kind of stuff, none of that matters unless they can extract it from the ground at a profit and return those profits somehow to the person investing in them. And every time you're looking at a mining company, that is what should be in the back of your mind. So the life cycle of a mining company. A mining company is kind of like a baby. It's an idea before it's a real thing. People go out looking for a mine. A mine is not a business until they're taking it out of the ground and selling it at more or less of a profit. But the beginning stage, looking for a mine, can be, the exploration stage and development stage can be very lucrative, but are proportionately more risky. Now, the exploration stage, generally speaking, they explore for it, they look for it, they find some rocks and metal or whatever they're looking for, but then they have to define it. Just because you found metal in the ground, just because you found gold, for lack of another resource to talk about, doesn't mean it's going to be sufficient in size or grade that you could make money out of getting it out of the ground. It usually takes between 1 and 5 years to delineate a discovery, and then between another 1 and 5 years to apply a business plan to that, to do all the studies required to apply a business plan to something, to figure out how they can extract it from the ground economically and turn it into a mine. And once the market is confident that the business plan that they've applied to the resource for extracting those things is reasonable, then they will start financing it and turning it into a mine. But a huge amount of homework on the side of the companies needs to be done to prove to the market that it's worth building this very expensive mine. A good example of that is the mining market. There are about 40,000 mining companies in the world of some, whether they're private or not. 3,500 of those are listed. And the interesting thing here is that there are more companies than there are actually projects, which means there are a lot of guys just looking for a project that aren't really a mining company at all, or even an exploration company. Of the top 2,600 of those companies, 98% of the value is in the top 500, which tells you a lot about the fact that a number of junior companies are never going to turn into actual mining companies that make money and businesses that return profit to shareholders. And now, obviously, going from looking for a mine to building a mine is a long stage. The key investment principle is every time you are looking at an early stage project, when someone says, "I think I found gold in the desert somewhere in northern Mongolia," what are the realistic chances of that being a mine? And that is the question that you always want to ask when you're looking at junior mining companies. You have to apply a due diligence process and honestly just ask yourself some practical questions. Is this thing not going to be a business one day? Now, despite all of the amazing gold finds in Africa and Mongolia, the distribution of global mining projects around the world is still pretty heavily centered in first world countries, and that's because of security of tenure. So the investment dollars in the world have gone towards largely first world countries because that's where they believe that they will get the safest return for their investment. To dispel any rumors, a large cap mining company is 10 billion or more in terms of value and is always going to be a diversified miner. So a BHP Billiton, Anglo American, Rio Tinto, Glencore. These are large cap miners. Mid cap miners, they could do one or two commodities usually, and they have usually many mines, often a couple of one or two commodities, and they specialize in it, but at a very, very large scale. Small cap is between 100 million and a billion, and they are usually single company, single project companies that would hope to eventually get themselves sold into a mid-cap or large-cap producer. And then micro-caps, the $1 million to $100 million market, and those guys, they tend to be explorers and developers. There's a few exceptions of some smaller producers in that range, but those tend to be explorers and developers. The top ones you all think about is gold in the mining business, but the reality is the commodity that is worth the most money in the world and that is mined in the largest tonnage in the world is actually coal. These are the top 12 commodities, and between them, they make up about 95% of the mining market. If you are investing in one of these commodities, they all have different demand and supply profiles, but this is the main market, and they're not all metals, and a number of them are huge. Sticking to the metals that you know and that are traded on the LME is not often the safest way to invest in mining, and it's definitely not the best way to diversify your portfolio. The mining market is huge. It's worth trillions a year, and if you truly want to invest across the mining spectrum, you need to be looking at least all of the commodities on this list. Mining companies are fundamentally driven by the demand and supply of the commodity. The commodity markets absolutely are intrinsically linked, and they're linked to demand and supply. We build more mines when demand is high, and we build less mines or close down mines when demand is low. There's a certain amount, about 90% of the mining market that is going to happen every year no matter what. The price fluctuations in demand and supply that occur in the margins. It's the top 10%. It's whether we go up or down 10% that causes huge fluctuations in the price. One of the reasons why mining is considered a safe jurisdiction is because there is no way in the world we can stop consuming the products of mines. If we go back quickly, gold and perhaps iron ore on here are arguably not necessary to our well-being as commodities. The rest of the commodities, and diamonds and platinum, actually just diamonds, the rest of them are absolutely essential to the day-to-day life of the over 6 billion people living on this planet. We are a consumption-driven, and that doesn't mean just buying our iPhones, which the metals go into as well. We're a consumption-driven economy. Potash and phosphate are necessary for the food that we eat every day. Without mined fertilizers, we simply would not be able to feed the planet. Copper is essential to the way of life that we know. Coal is absolutely essential and is still the largest form of electricity generation on the planet, despite all of the green energy and all of the nuclear and all of the oil. Coal is where a good 60% of our energy comes from. That mix is changing, but as long as you believe that people will continue to live and consume, you will have a 90% baseline demand for all of the commodities. And that's why mines, fundamentally, the majority of them, are not going out of business. Now that extra 10% is driven by something else. It's driven by largely urbanization and growth, or lack of growth. And that's where that fluctuation occurs. And if you want to invest in an upcycle in mining, doing it in a growth period of global economic growth is a good thing. But on the other hand, you have to consider where we are in global growth to know which commodities and mining companies to invest in. In an early stage of growth, you're building a lot. You're building cities, you're putting in the concrete and highways and all of that kind of stuff. And that's when steel and iron ore become massively demanded. The super cycle in China, largely driven by China, was driven by bulk commodities. Now that super cycle has peaked out. Now the super cycle is still running its course, but the demand for iron ore, it gets used, but then we don't consistently use iron ore the way we consistently use other commodities. Once we've built the basic infrastructure, then we need mid-cycle commodities like copper, lead, and zinc, and then late cycle that go into the wires and the washing machines and all of the stuff that they need to live to put into the homes that they've built for growth. And then late cycle commodities like platinum and nickel that coat the chrome fittings on your pretty doors and put the nice diamond rings on the nice wife that you brought home for different things. The interesting thing is early cycle commodities peak and go down, as we've seen in the iron ore prices and iron ore companies. But mid-cycle commodities end up being added to that baseline demand that I was talking to. So once we increase the demand for things like copper, lead, zinc, platinum, and nickel, that demand then gets added to our baseline demand and gets consistently consumed as part of that 90% of regularly consumed commodities that need to exist in order for the world to keep going on an even keel. Some major indicators that you want to look at if you're investing in mining and you want to know timing. The demand for metals directly follows global GDP. So when global GDP is rising, the demand for metals will follow it. The recent slump in metal demand has been because of a flatlining of growth in global GDP. The prices follow OECD output, which means when we're producing goods that require the metals and mined products, it's the price, once those goods have been bought and they've bought the metals, that's what pushes the prices up. So it's manufacturing. So when the manufacturing index goes up and OECD output, which is directly linked to OECD output, that's when you're going to see the prices rise. The demand goes first, the prices come after. And metal consumption is directly linked to global population and urbanization. And although that global population doesn't grow in a straight line, and urbanization definitely doesn't grow in a straight line, they have been consistently increasing for the last 30 years. And unless every economist in the world is wrong, they will continue rising till about 2050. Mining really is a global business. This is just gold projects, but you'll find that this spread is pretty consistent for most commodities, for most major commodities. You can find them all over the world. Now, that makes mining one of the most global, arguably the most global business on the planet. And you have a lot of choices in terms of where you invest your money into mining companies, because really, you can find them on just about every country on the planet. So there's no jurisdictional specialties, although you need to be careful when investing in different countries for different reasons. This is just a little bit of a recap of what we were saying earlier. The majority of projects in the world are looking for and developing potential mines. But if you look at the number of operating mines compared to the number of explorers and early stage explorers, it dwarfs exponentially that number. So it's just a word to the wise about when you're investing in the market, where the safe investments are. Explorers, very simply, companies that are looking for assets, companies that are looking for the next gold mine. Now, why are there so many explorers? Because realistically, if you find something from nothing, if you find a gold deposit in the middle of nowhere where there was nothing before, you can increase your money 10 or 20-fold. But you have to understand that there's an inverse risk. If you find something and it's worth 20 times more than you paid for it, that means there's a 19 in 20 chance that you'll find nothing and you will lose your entire investment. And that is the ultimate risk of investing in the junior exploration space. Developers are, once they have discovered a project, they start developing the project and try to apply business feasibility, technical things to determine whether or not they can then get that deposit out of the ground economically. Just because you're a developer does not mean that you are going to be a mine. It just means that there's a much better chance you're going to be a mine. So when do you want to invest and at which stage? The honest truth is, if you think that they're going to find a mine and you have the technical expertise to read the technical data and think that an exploration project is going to be a significant discovery, then definitely come when they're releasing their initial drill results. And if you can read those drill results, it's a great time to invest because you will make that super fun 5, 10, 15, 20 bagger that all of you are hoping for. But you need a whole lot of technical expertise and or a whole lot of luck to determine whether or not that is going to be the case in your exploration project. So I would, unless you've got some really good advisors, or you know a lot yourself, be cautious at investing at that stage. The next stage, and it's actually, in my opinion, where my personal sweet spot is for investing in the mining industry, is when they've made the discovery and they've applied economics to it, and I can make a reasonable deduction based on my knowledge of the market in terms of, is this commodity price going to be, is this a commodity that's going to be in demand in the next little cycle? So is it a popular commodity? And is it reasonable that they're going to get financed into production? And if you can make that kind of determination, I think that the feasibility stage investments, or if you anywhere in the feasibility stage, is a not bad time to invest, and you can make almost as much money as if you invest at the exploration stage. How do you determine what is a reasonable price for a mining company? These are proper calculations, but the reality is you can just say it's going to make X amount of money in X amount of years and calculate a net present value of it, but mining companies very rarely trade at net present value. The internal rate of return, also a very reliable financial metric. It's a good way of comparing one company to another, knowing what their internal rate of return is. And my personal rule of thumb is I won't touch something that has an IRR less than 30%, in the mining space, that is. But the best way is actually comps. To know what you're worth is what are other companies with similar assets, whether in the same metal or not, or the same size, worth. So what are similar companies worth per ounce? So if a company has 2 million ounces and one has 1 million ounces, arguably, and they're very similar companies with similar metrics, arguably one should be worth half of what the other is on a regular basis. Or another company that's likely to make 50 million in revenue per year in 5 years in commodities in a similar country. You're looking for comparables. In the mining market, comparables and a set of peers is often the best, in the junior market, is the best way to determine what the fair value could be if something is well managed. Back to what we were talking about before. Grassroots, early exploration, 1 in 100 chance of being a mine is the general rule of thumb. After you've done all your drilling and you've discovered an asset, it's got 1 in 20 chance of becoming a mine. And once you've applied economics to it, it's got about 1 in 10. Valuing producers is a bit of a different game. All of these are good methods. The reality is you have to use them together. And you have to compare them across other producers to know what something is worth. Right now, mining producers across the board are being valued at the lowest price to earnings ratios of any commodity, of any sector in the market. Arguably, this is a massive bear market in the mining sector and should be good value, and there is sector rotation occurring to invest in mining now. That being said, bear markets tend to last longer than most people expect. But arguably, on all of these valuations, mining is a very undervalued place to invest your money right now and is worth considering. And when and if, but hopefully when, commodity prices do normalize and come back to the norm, producers will be the first companies to come back to that norm with them and should be one of the first places you're looking to invest your money. How do you invest? Pick your risk appetite. We saw the chances of success for various mining companies. Don't invest in exploration unless you can afford to lose your money. Period. You could make great returns, you could lose all of it. There's lots of ways to invest in mining companies. You can pick stocks. If you like doing your homework and you enjoy investing, there's so much to learn in investing in mining. I enjoy it, I love it, it's why I do it. But you can't afford not to do your homework in mining. Mining is too complicated not to do your homework. So unless you're willing to do your homework, don't just stock pick. The other option is to pick experts to do it for you. Fund managers who have a lot of experience and spend their life doing homework are not a bad way to invest in the mining market. And much like stocks, you should compare fund managers. Some fund managers perform well, some fund managers don't. So if you are going to invest in a fund of sorts as your way of investing in the mining sector, make sure you're comparing the different fund managers and how they've performed. And then there's always ETFs. If you don't like the mines, they're too complicated, and you just want to make a bet on the commodity price, commodity ETFs are very popular. The lovely Angelos Damascus is going to be speaking after me, and he will be giving you instructions on how to specifically invest in gold miners. The rules of investing in mining still apply to gold miners, but gold is a financial commodity. It is not controlled by supply and demand like every other commodity in the world, and there are very specific ways where you have to invest in gold. And always consider that when you're picking gold versus a regular mine, and understand that it's a financial commodity that is much more complicated and needs specialized instruction. As mentioned earlier, you must do your due diligence. I gave you some indicators to watch the general market earlier. There is no excuse in the mining market for not doing your homework. The reality is right now, financial websites like ADVFN, Proactive, Share Profits, even the CIA fact book, there is no absence of information out there. You need to find the information. Google Finance is a surprisingly great method of looking things up. But there's a lot of questions I'm going to tell you need to ask about mining companies going forward, and you need to answer all of them before you do. Meeting a company face-to-face is actually very, very important. As mentioned earlier, promotion in the mining sector is massive. Miners have been promoting mining companies for hundreds of years. You need to be able to look someone in the face and know or make a call on whether or not they are the kind of people you want to be investing in, and whether or not, when it's not hidden behind a bunch of facts on a piece of paper, they have a real, concise idea of how they're going to turn the money that you're investing in them into profits, and a realistic timeline for doing that. Domicile is quite important. Jurisdiction, we'll discuss later, is massive, but the domicile of where the company is based is also important. There are different rules for where companies are set up. So not just where they're mining, but also where the company is set up and how secure that jurisdiction is is the rule of law going to be upheld? Are they going to be able to defend your assets if push comes to shove? And that is based on where your company is registered. Word to the wise, bulletin boards are the new normal when it comes to investing. They are important. If you want to gauge sentiment at any given time, bulletin boards are an excellent way to do that. And when it comes to trading, sentiment is massively important. That being said, there is no qualification for getting onto a bulletin board. I sometimes read things on bulletin boards that are so incredibly inaccurate. They are outright lies, but anyone can post anyone, whether they're promoting a stock up or promoting a stock down. People who misinterpret the facts, but sound quite convincing. Gauge sentiment on a bulletin board, but do your own homework before you take any actual advice from one, is my advice to you. Basic questions that you need to ask before you invest in any mining company. Who really owns the asset? It's great to say I've got a 10 million ounce gold mine in Canada, but and you might have some of it, but there's a small line in the fine print that they own 40% of it or 60% of it. See what the ownership is. You should prefer to invest in companies that have 100% ownership over the assets they've got. Jurisdiction is major, security of tenure. Despite the fact that it is arguably quite expensive to mine in Australia and Canada, there is still more mines there than almost any other individual country in the world. The reason for that is the rule of law applies. You have security of tenure. There are too many countries in the world where you invest, arguably tens if not hundreds of millions of dollars, and on the whim of a new political government, you might lose that asset. You have to decide whether or not that country is worth investing in, or whether the people operating know how to operate in that country. But there is significant risk that needs to apply to every mining investment based on the country you're mining out of. Growth prospects. The reality is you want to see in anything, it doesn't matter how great the mine is, or if it's a steady producing mine, they steadily produce 100,000 ounces, let's say, of gold per year, nice little margin. But if nothing's happening, your share price probably isn't going to move. In any company that you invest in the mining space, you want to see a list of what all the news flow is going to be. And that's why development assets can be so interesting to invest in, because there are milestones that de-risk a project every step of the way. And if there are lots of upcoming milestones, there are lots of times and places where that company can re-rate. Or even a producing company who's looking for new assets on their properties, or developing more assets, or increasing how much they mine. But realistically, news flow is very important. Steady state, while it is very secure and dependable and hopefully paying you dividends, might not necessarily drive share price. General market conditions. The market for mining right now is very, very bad. We're in a bear market. The contrarian says, invest now, it's undervalued, it's very, very cyclical, it will go up. That being said, in a bull market, you can almost invest any time, and if you're a little bit smart, it's going to go up. In a bear market, if you are investing, you need to invest very carefully. And there are bull market buys and bear market buys, and you can figure out what they are on your own, but realistically, different things at different times. Really big important thing, where it sits on the cost curve. If you want, the reality is things that are very high cost make money because they have huge tonnage and they're just huge in value. But if you want to be absolutely secure, the best miners that I know invest in the lower half of the cost curve. Because that means that even if the commodity price moves down or against them, they're still going to be making money. They're still going to be alive. Margin, as we said at the very beginning, mining is a business. And whatever mines in front of you has to present a reasonable, salient plan for how they are going to make money, which means make profits, and hopefully eventually return some of that money to you. The security of their ability to make profits is based on their place on the cost curve and where their margins are going to be. Realistic timelines. Anyone who said that they found a beautiful gold mine last year and they're going to be in production next year is lying to you. As I said, it takes 1 to 5 years to find a project and 1 to 5 years to develop a project, a couple years usually to build it. So from the beginning, the shortest timeline I've ever seen from discovery to production is about 5 years, from first discovery to production. It can take 10 to 15 years to build a mine. You want a realistic appraisal of when you're going to make money on that mine when you're investing. Because saying that it's going to be a 500,000 ounce a year producer is great, but if that happens in 10 years, you're not going to get a return on your investment. So when they're telling you what they're going to do, make sure they apply realistic timelines to it and you ask what those timelines are. Grade and size of deposit. The reality is, the higher your grade and the bigger the size of your deposit, the more money you're going to make. So much like margins and being in the bottom half of the cost curve is very, very important, there are always exceptions, but on the whole, higher grade, larger deposits, and things sitting in the lower half of the cost curve make more money. It is an absolute rule. If you're in those categories, you will make money. You could make money if you're out of those categories, but it's less certain. I could not stress this more. Management, actually more than size, grade, and place in the cost curve, I think is the most important thing. The ability to execute a project. I have seen beautiful deposits that never go anywhere with bad management, and I have seen very mediocre deposits do extraordinarily well with sound management. And the way that you check good management is, one, hopefully meet them face to face and look them in the eye. And then there's the much easier method, which is look at what they've done before. I have very, very rarely seen a good manager that doesn't have a track record of good projects behind him, projects that made money behind him. So always check the history of all key management positions on the board and on the management, the C-suite. In addition to that, don't necessarily take their bio on the presentation at face value. They're only going to put the highlights in the bio. Do some separate work. Make sure that in addition to doing one successful project, they didn't have 5 unsuccessful ones. You want a good board. You want a board that is there to protect your money. You want a board that is there to protect your money, that is balanced, that has people from the country you're operating in on it who can make your jurisdictional risk go down. You want guys who have done it before. And ideally, you want investors. You need to be careful in the mining market of lifestyle companies. Always ask what the cash burn is and what the top management salary structure is. The reality is, if you have a mine or a discovery or a mine that's worth less than $100 million, you really shouldn't be making $500,000 a year in salaries. It's just not right. Salaries need to be in line with the size and success of the company, and it is absolutely your right as investors to ask what those salaries are and make sure that the people doing the work are doing the work for an appropriate amount of money, because ultimately they're spending your money. Funding is quite important. Much like there's lots of stages on the timeline of growing a mine, at every stage where they're trying to do things to grow that mine, it's going to cost money. Now, funding isn't a bad thing, and dilution isn't a bad thing, but the key point is you want to make sure that every time they raise, for a small example, if they raise $1 million to work, I think you'd want to hope they'd be adding at least a couple $1 million worth of value to the company. Diluting is not a bad thing, and neither is raising money. They will all need to do it, but you want to check that every time they did it, they added value to the company. There's lots of different types of financing that are less dilutive. Not all of them are good. Convertibles can hurt you. Debt has to be balanced. 60 to 70% debt ratios is as high as you should go when you're building a mine. You don't want 100% debt, it's dangerous. Optimal time to raise cash is obviously for miners is when their stock price is high. For you is when their stock price is low. And when you are investing in miners, the truth of the matter is, if you can find a way to access placements, you will get the best value for your investment. And there are a lot of new ways of being able to access placements that are becoming available to retail investors. Talked about value creation earlier. Every time you invest money, you want to see them putting that money to work so it creates value in the company. Rule of thumb, once it starts making money, take some of your profits off the table. It's just a good rule. The reality is miners and mining goes up and down. If you've made a little bit of money, always take profits. And the time to exit is not when everything's gone wrong and it's worth nothing. The time to exit is when you see the company stop creating value, when there are no reasonable places for development going forward. So many juniors fail because they're not creating value. They're lifestyle companies or they're pure exploration that didn't have much of a chance to begin with. Invest intelligently, be wary of juniors, and only invest in juniors where you know the management and you've done your homework. And once you've made a little bit of money, always take some profits off the table. General rule of thumb also is that good companies attract good investors. You want your management, especially in a small company, to have skin in the game. Part of their presentation should always be able to tell you how much money core management has in. And frankly, as a rule, in a junior company, not in a much larger company, obviously, but in a junior company, you want a management to have at least 10%. Debt, royalties, and offtakes, as we discussed earlier, are good, but you want blue chip debt, royalty, and offtakers. The fact that good blue chip companies are willing to take your offtake and willing to offer you debt is usually an indication of the soundness of the company. This is a chart of the last 30 years in terms of mining markets. The average duration of a bear cycle is 45 months, and the average decline is 75%. The current duration of this bear cycle is 54 months, and the current decline is 76%. It is arguable that we are probably coming near the close to the end of this bear cycle in mining, if the last 30 years are any indication. The good news is the average duration of the last 4 bull cycles in the mining market in the last 30 years was 49 months, and the average rise was 218%. If you are a value investor, this is arguably, and a contrarian, this is arguably one of the best times to get in and do your homework while we're at the bottom to find the right companies to invest in. So I'm going to quote someone who I think knew a little bit about making money in the commodity and mining markets, and it is buy at the bottom. Buy low, sell high, and this is arguably the lowest point you're going to get to in the mining market. So you have a unique chance of being able to do your homework at the bottom right now and try to get in. I have to finish up because there's someone coming in after me. Before I go, are there any quick questions? Of Glencore? I actually like it a lot. I think it's undervalued right now. It's being beaten down in the markets because people don't understand it. They've taken its debt. Glencore has arguably higher debt, but 50% of Glencore is a trading company, and trading companies always have a higher amounts of debt than mining companies do. And the reality is Glencore is not just a mining company, it is a mining company and a trading company. And their trading side is doing very, very well, and they have lots of synergies. Unfortunately, it's being valued just as a mining company, and that makes its metrics look not as attractive. Any other questions? Mark Kudafani's having a really bad year. The mining market's doing horribly, and Anglo-American suffers from the fact that it's in a very difficult jurisdiction, that a number of its assets are in South Africa, which is presently a very difficult jurisdiction to operate in. Fundamentally, Anglo is a very well-run company. It's being affected by the overall bad sentiment in the mining market and where its jurisdiction is, and I can't comment on whether or not the market's going to decide to like those things again or not. But I will say that I know a lot of people who work at Glencore, and I've looked at their fundamentals. They are a very efficient, well-run mining company. I got to go because I'm over time. Thanks a lot.